Do you realize that every dollar you invest today is a seed for the wealth you will harvest tomorrow? Successful investors follow investment rules that turn small steps into massive wealth over time. What if the only thing standing between you and financial freedom is the courage to start investing? Every successful investor knows this. The market rewards those who respect investment rules. Follow investment rules and money will grow for you. Ignore them, and money will grow against you. This audiobook is your wake-up call. As Benjamin Graham said, the investor's chief problem, and even his worst enemy, is likely to be himself. Successful investors aren't born with secret access. They build clear rules that protect them from panic, hype, and sloppy decisions. Successful investors do not predict the future, they prepare for it. In the next minutes, you'll learn how top investors think, how they choose opportunities, how they manage risk, and how they stay calm when others get emotional. These rules are practical, repeatable, and designed for real people with real budgets. And if this audiobook helps you, hit like, subscribe, and join us for the next audiobooks. Every rule here can change your future. And remember, the moment you respect investment rules is the moment your financial life begins to transform. Investment rule number 1. Start small, stay consistent. If you want to become a real investor, not a gambler dressed up with a brokerage app, you must accept one truth early. You do not start big, you start right. Starting small is not a sign of weakness, it is a strategy of survival. Most people lose money in the first year because they try to feel smart, rich, or special on day one. They throw a large amount into something they barely understand, then panic when the price moves against them. That is not investing. That is ego paying tuition. Starting small keeps your ego out of the driver's seat. It gives you room to learn without bleeding. It lets you make mistakes that educate you instead of destroying you. Small steps remove fear because they reduce the size of consequences. Fear is not your enemy by itself. Blind fear is. When you invest a small, safe amount, your mind stays clear. You can observe what happens with curiosity, not terror. You notice how markets move. You feel what volatility does to your emotions. You learn the difference between a normal dip and a real problem. You develop patience because nothing forces you to act out of desperation. One small investment teaches you more than 10 books if you are paying attention. This is how competence is built. Not by making a heroic bet, but by repeating smart actions until they become natural. Staying consistent is the second half of the rule, and it matters even more than the first. Anyone can invest once. That is not a skill. The skill is showing up again next week, next month, and next year, even when you are bored, even when you are busy, and especially when you are scared. Consistency turns investing into a system. Systems beat moods. When you invest on a schedule, you stop waiting for the perfect moment, because the perfect moment does not exist. Markets do not ring a bell when prices are low. News will always feel uncertain. If you wait for certainty, you will wait forever. A schedule forces action. It makes progress automatic. It removes the drama from growth. Consistency also creates the most powerful force in finance: compounding. Compounding is not magic. It is mathematics with discipline attached to it. Money grows on money. Returns earn returns. But compounding only works if you keep feeding it. One big deposit followed by silence is weaker than small deposits stacked for years. Think about it like planting a tree. You do not throw a forest into the ground in one day. You plant, you water, you protect, and you repeat. Then one day, the shade is real. The investor who stays consistent becomes unstoppable because time becomes an ally instead of an obstacle. There is another reason consistency beats intensity. Intensity is emotional. It pushes people to chase what is hot. It makes them jump in and out of positions like a nervous tourist. Consistency is rational. It makes you buy in different market conditions. which lowers your average cost and protects you from bad timing. You will buy when prices are high, yes. You will also buy when prices are low. Over time, that balance works in your favor. It is not exciting. It is effective. If you need excitement, go watch a movie. Investing is supposed to be boring. Boring is profitable. Starting small and staying consistent also trains your identity. You become the kind of person who invests, not someone who tries investing. That psychological shift is massive. When you invest consistently, you stop seeing it as a risky event. You start seeing it as a normal part of life, like eating, sleeping, or working. Your brain adapts. Your confidence grows. You feel ownership over your future instead of hope. You stop asking, "Should I invest?" and start asking, "How can I invest better?" That is the difference between amateurs and professionals. Do not confuse starting small with staying small. The point is not to remain cautious forever. The point is to earn your growth. You increase only after you prove discipline. When your system works at a small scale, you can scale it safely. If you cannot invest 100 consistently, you will not handle 1,000 consistently. The money does not change your character, it exposes it. So build the habits first. Let your behavior prove you are ready for more. Discipline comes before size, always. If you are serious about wealth, stop looking for a shortcut. Your first investment is not a stock, a coin, or a property. Your first investment is a rhythm, a steady rhythm. Small, controlled, repeatable actions that you can sustain for years. If you do that, you will not need luck. You will not need perfect predictions. You will not need a miracle. You will have a process. And process is what successful investors trust. Start small, stay consistent, and let time do the heavy lifting. Investment rule number 2. Invest only in what you understand. Invest only in what you understand because confusion is not a strategy. If you put your money into something you cannot explain in plain words, you are not investing, you are gambling with a suit on. Many people lose wealth not because the market is evil, but because they bought stories they did not truly grasp. They copied a friend, followed a headline, or chased a chart without knowing what creates value underneath. Then the first time the price drops, they panic because they never had a real reason to believe in the investment in the first place. Understanding is your first line of defense. When you understand how an asset makes money, you can measure its risk. When you do not, risk becomes invisible until it hits you in the face. A business is not a ticker symbol. It is a machine that turns inputs into cash flow. A property is not a fantasy of rent. It is a physical asset with expenses, tenants, regulations, and market cycles. A fund is not a magic box. It is a collection of holdings driven by a method you should be able to describe. If you cannot say, clearly and simply, where the return comes from and what could destroy it, you have no business putting money there. The market punishes blind confidence. Hype is loud. Understanding is quiet. Hype promises fast rewards. Understanding asks hard questions. Hype tells you, everyone is buying this. Understanding asks, what is the real value and why? Hype makes you feel smart for joining the crowd. Understanding makes you humble enough to study. If your investment decision depends on excitement, you will sell in fear. If your investment decision depends on clarity, you will hold through noise because you know what you own. This rule is also about control. You cannot control the market, but you can control what you choose to learn. You do not need to understand everything in finance. You only need to understand what you buy. That means doing basic work before you invest. Read how the business earns revenue and what costs eat it. Learn what drives demand. Know who the competitors are. Understand the balance sheet in a simple way. What the company owns, what it owes, and whether it produces real cash. If it is real estate, understand the neighborhood, the rental demand, the maintenance costs, and the numbers that make the deal work. If it is a bond or a fund, understand what is inside it. how it reacts to changes in interest rates, and what fees quietly drain your return. You are building your safety through knowledge, not through hope. People often avoid this rule because they think understanding takes too much time. That is a lazy excuse. You find time for what you value. If you're about to place your hard-earned savings into something, you owe yourself the respect of learning it. The painful irony is that people who refuse to study an investment spend 10 times more time later worrying about it. Confusion creates anxiety. Anxiety creates impulsive selling. Impulsive selling creates losses. Understanding does the opposite. It gives you conviction, and conviction gives you patience. Another reason this rule matters is psychological. Investing is not only numbers, it is behavior. When prices fall and headlines scream, your mind looks for certainty. If you do not understand your investment, you will borrow certainty from the crowd, and the crowd is usually wrong at turning points. You will sell when you should hold or buy when you should wait. But when you understand, volatility becomes information, not a threat. A drop may mean a better opportunity, or it may mean your thesis is broken. You can tell the difference only if you know what you own. Understanding also protects you from being manipulated. There is an entire industry built on selling complexity. Complex language makes weak products look intelligent. If someone cannot explain an opportunity without hiding behind jargon, they are not educating you, they are controlling you. A strong investment does not need mystery. It can be explained to a smart beginner. The best investors in the world are not people who memorize fancy formulas. They are people who see clearly. They reduce confusion until the decision becomes obvious. Simplicity is not the enemy of sophistication. It is the result of sophistication. Let us be blunt. If you buy something because a stranger online said it will go to the moon, you are not an investor. You are a passenger. Passengers get scared at turbulence. Investors fly the plane with a map. Your map is understanding. That is why the rule says only in what you understand, not only what you like, or only what is popular. You can like something and still not understand it. You can be excited and still be blind. Your money does not care about your excitement. It only responds to your decisions. This does not mean you must be an expert before you start. It means you must be honest about your circle of competence. Start where you can learn fastest. Begin with simple, proven assets. Learn one area deeply instead of 10 areas shallowly. Your competence expands over time when you study consistently. Each year you invest with understanding, you grow not only your capital, but also your skill. That skill becomes compound interest in your brain. It makes future decisions sharper, safer, and more profitable. When you practice this rule, you stop chasing noise and start building wealth. You stop dumping money into trends and start placing money into value. You stop fearing volatility and start using it. You begin to see investing as ownership, not betting. And ownership requires responsibility. The responsibility to learn, to think, and to act with clarity. So here is the bottom line. If you cannot explain it, do not buy it. If you cannot explain how it makes money, do not touch it. If you cannot explain what could make it fail, you are walking into danger with your eyes closed. The world is full of opportunities, but opportunities are not equal to profits. Profits come from choices made with understanding. Invest only in what you understand, and you will not need luck to win. You will need discipline, patience, and clarity. That is how successful investors stay successful. Investment rule number 3. Build a network of investors. You can read every book on investing, watch every chart, and memorize every rule. But if you stay isolated, you will grow slower, make more avoidable mistakes, and miss opportunities that never show up on your screen. Investing is not just a math game. It is a human game. Markets move because people move. Deals happen because people trust people. Information flows through relationships long before it becomes headlines. If you are trying to build wealth alone, you are choosing the hardest path on purpose. Let us be blunt. Most investors fail for the same reason most people stay broke. They listen to the wrong voices. They take advice from friends who never invested, from relatives who fear every risk, or from loud strangers online who confuse confidence with competence. A strong network protects you from that noise. When you surround yourself with serious investors, your standards rise automatically. Your thinking sharpens. Your emotional control improves. You start measuring ideas, not believing stories. You learn faster because you are exposed to real experiences, not just theories. A network of investors is not about collecting contacts like trophies. It is about building a circle that forces you to think clearly and act wisely. Successful investors talk to people who challenge them. They share ideas and expect to have them attacked in a good way. They ask hard questions. Why now? Why this asset? What is the downside? What is the real value? What would make you wrong? If you cannot answer those questions, you do not deserve to invest yet. A real network does not flatter you. It refines you. Think of your network as a mirror. Alone, you can lie to yourself. You can convince yourself that a weak investment is long-term, that a loss is temporary, or that a risky bet is a once-in-a-lifetime opportunity. In a strong investor circle, those excuses die quickly. Someone will point out the hole you missed, the bias you fell into, the risk you ignored. That accountability is priceless. It saves you money before you lose it. It keeps you from repeating the same mistakes again and again. A good network also gives you access to better thinking, better tools, and sometimes better deals. You will hear about opportunities early. You will see how experienced investors structure investments, negotiate terms, and manage risk. You will learn what is working right now and what is failing, not from rumors, but from people living it. You cannot buy that kind of insight. You earn it by showing up, contributing, and building trust. But here is the part most people get wrong. They want to take before they give. They enter rooms hunting for shortcuts, secrets, or someone to hand them a winning investment. That attitude is obvious, and it repels serious people. If you want a real network, bring value first. Share what you know. Offer help where you can. Make introductions. Bring a fresh perspective. Ask thoughtful questions. Do basic research before asking for someone else's time. When you respect people's time, they respect your potential. Building this network is not complicated, but it requires humility and consistency. Start where investors gather. Local meetups, business events, real estate groups, stock market clubs, entrepreneurship circles, online communities with strong moderation and high standards. Show up repeatedly. Familiarity builds trust. Listen more than you talk early on. When you speak, be precise. Do not pretend to know what you do not know. Serious investors respect honesty far more than fake confidence. Choose your circle with standards. Not everyone who calls themselves an investor is worth learning from. Avoid the performers, the hype addicts, and the people who sell fantasies. Look for those who think in probabilities, talk about risk openly, and can explain their strategy without drama. Look for those who have survived bad markets, not just those who brag in good ones. Experience shows in calmness, not noise. A powerful network is also diverse. Do not build a circle of clones. You want investors from different asset classes, different industries, and different levels of experience. Diversity prevents groupthink. It exposes blind spots. It gives you a wider map of reality. One person may be strong in business valuation. Another may be excellent in real estate. Another might understand market psychology. Your goal is not to copy anyone. Your goal is to see through multiple lenses and make better decisions. Use your network to improve your process, not to outsource your responsibility. Do not ask people what to buy. Ask them how they think. Ask them what risks they see. Ask them what they would research next. Your capital is your responsibility. A network does not replace your judgment. It strengthens it. Over time, this network becomes your personal board of advisors. When you are tempted to chase a trend, they pull you back to reality. When you are afraid to act, they remind you of your plan. When you are stuck, they show you a new path. And when you win, they celebrate with you without envy, because they understand the game. That is rare in the outside world. If you want to become a successful investor, stop treating investing as a solo sport. Skill grows in community. Wisdom grows in conversation. Discipline grows in accountability. Build relationships with people who are where you want to be and who think the way you need to think. Your future portfolio will reflect your circle. Choose it like your wealth depends on it, because it does.
Investment rule number 4. Invest in yourself and keep learning. Listen closely. If you treat investing like a shortcut, it will treat you like a victim. The market does not reward wishful thinking, loud confidence, or blind luck. It rewards competence, and competence is not something you are born with. It is something you build. The greatest investors are not magical. They are trained. They are crafted by years of learning, testing, failing, and refining. Your money will never consistently outperform your mindset. If your knowledge is weak, your results will be weak. No strategy can save a person who refuses to grow. Most people want returns without preparation. They want profit without pain. They want to copy a successful investor's portfolio without copying their discipline. That is why they panic in downturns, chase hype in upswings, and blame everything except their own ignorance. Here is the truth you need to swallow. The most important asset you will ever own is not a stock, not a business, not real estate, not even cash. It is your ability to make intelligent decisions. A foolish investor with $1 million becomes a broke person with a story. A skilled investor with a small amount becomes a wealthy person over time. The difference is not the market. The difference is you. When you invest in yourself, you create a return that cannot be taken from you. A company can fail. A market can crash. A currency can lose value. But knowledge compounds inside you. It changes how you see risk. It changes how you react under pressure. It changes which opportunities you even notice. Financial literacy is not a luxury. It is a survival skill. If you do not understand what you buy, you do not own an investment. You own a gamble. And gamblers eventually pay the price. Start with the basics. Learn how money actually works. Learn the difference between income and cash flow. Learn why valuation matters more than excitement. Learn what makes a business durable, what makes debt dangerous, and what makes a trend temporary. You do not need a PhD. You need clarity. You need to understand the language of investing well enough to spot nonsense instantly. The market is full of people selling dreams wrapped in complicated words. If you cannot translate those words into simple logic, you are not ready to risk your capital. Then go deeper. Study psychology. Because the hardest part of investing is not math, it is emotions. Fear makes you sell low. Greed makes you buy high. Ego makes you hold losers too long and winners too short. Impatience makes you overtrade. Envy makes you chase what is not yours. Successful investors win Because they master themselves before they try to master markets. They know their biases. They know their weaknesses. They build systems to protect themselves from their own impulses. If you want to invest like a professional, start thinking like a psychologist. You must also learn from real experience. Reading is powerful, but only if you apply it. Every investment you make is feedback about your thinking. Did you buy because you understood value, or because you felt pressure? Did you manage risk, or did you hope? Did you follow a plan, or did you follow noise? After every decision, review your results without excuses. If you were wrong, do not hide from it. Own it. Extract the lesson. That is how skill is built. The market charges tuition. Pay it once, learn the lesson, and move forward stronger. Do not let pride block your growth. The investor who believes they already know enough is the investor about to get humbled. Markets evolve. Industries change. New tools emerge. Old assumptions break. What worked 5 years ago may break tomorrow. The only investors who survive decades are learners. They are humble enough to say, "I might be wrong," and disciplined enough to update their views when evidence changes. That mindset is not weakness. It is strength in its purest form. Investing in yourself is also practical. It means surrounding yourself with better ideas. Read high-quality books. Study the letters and interviews of top investors. Take courses that sharpen your understanding of accounting, business models, and risk. Follow people who teach principles, not hype. Train your attention like an athlete trains muscle. Protect your mind from garbage information. Every hour you spend consuming low-value noise is an hour stolen from your future wealth. And yes, invest in skills that increase your income. Your investing capacity depends on your earning power. If you level up your professional skills, you create more capital to deploy. If you learn negotiation, sales, coding, design, or any high-value craft, you widen the channel through which money flows into your life. Then investing becomes easier because you are feeding your portfolio more consistently. You are not relying on a single lucky win. You are building a pipeline of capital. Here is another reality. In the early years, the return on learning is usually higher than the return on any asset you can buy. A small improvement in your decision-making can save you from a giant mistake. A clearer understanding of risk can protect you from losing years of progress. A deeper grasp of valuation can help you buy quality at the right price. These advantages compound just like money does. You become the kind of person who sees opportunity early, holds through volatility calmly, and exits with logic instead of panic. So stop asking for the perfect tip. Stop looking for a miracle trade. Stop waiting for confidence to magically show up. Confidence is built by competence. Competence is built by learning. Learning is built by repetition. You do not rise to the level of your goals. You fall to the level of your preparation. If you want wealth that lasts, you must become someone who deserves it. Not morally, competitively. The market does not care about your hopes. It respects only skill. Make this rule non-negotiable. Every week, learn something that makes you a sharper investor. Every month, review your mistakes and upgrade your process. Every year, widen your understanding of markets, businesses, and human behavior. Over time, your returns will not just come from your money. They will come from who you have become. and that is the highest return investment you will ever make. Investment rule number 5. Keep a cash buffer. You want to invest like successful people? Then stop treating cash as useless or lazy money. A cash buffer is not a beginner habit. It is a professional rule. It is what separates investors who survive bad seasons from investors who get erased by one surprise. When you hold cash on purpose, you are not being fearful. You are being prepared. You are acknowledging a simple truth. Life does not ask for permission before it hits you with a bill, a setback, or a once-in-a-decade opportunity. If you do not keep a buffer, you are not investing. You are gambling with your future. Let us be direct. Without cash, every problem becomes a crisis. A car breaks. A family emergency shows up. A client stops paying. A job disappears. If you are fully invested with no reserve, you will be forced to sell something at the worst possible time. Not because it is smart, but because you are cornered. Forced selling is the silent killer of wealth. It turns temporary volatility into permanent loss. It is the difference between a setback that teaches you and a setback that breaks you. Cash gives you the right to wait. The investor who can wait controls the outcome. The investor who cannot wait becomes the market's victim. Most people think cash is for cowards because they confuse it with fear. Fear is freezing. A buffer is strategy. Successful investors understand that opportunity comes in waves, not on demand. When prices are high and everyone is celebrating, you do not need more risk. You need dry powder. You need the ability to buy when others are forced to sell. The great deals you dream about never appear when your account is empty. They show up when the crowd is stressed, when headlines are loud, and when weak hands are being shaken out. Cash is your invitation to those moments. It is your weapon of calm. It lets you act when your emotions are screaming to hide. You also need to learn the real job of cash. Its job is not to earn the highest return. Its job is to protect your life from your investments and your investments from your life. That is a huge difference. You do not build a cash buffer to feel rich. You build it to stay stable. When you have stability, you make better decisions. You do not chase hype. You do not panic sell. You do not borrow at ugly interest rates. You do not sacrifice long-term assets for short-term problems. Cash buys you space. Space buys you clarity. Clarity buys you wealth. Think about how investors actually lose, not in theory, but in real life. They lose because they are overextended. They lose because they go all in on a plan that assumes nothing will go wrong. They lose because they overestimate their tolerance for pressure. They lose because they believe they will be calm during a downturn, then discover they are human. A cash buffer is a pressure valve. It lowers the emotional heat. It gives you a rational bridge through uncertainty. When the market dips, you do not feel trapped. You feel ready. That shift alone can add years to your investing career, and careers create fortunes. Do not misunderstand this rule and turn it into laziness. A buffer is not an excuse to hoard money forever. It is a specific amount held with a specific purpose. Your buffer should cover essentials for a period of time, and it should sit somewhere safe and accessible. You are not trying to be clever with your emergency cash. You are trying to be certain. Certainty in cash allows boldness in investing. If you want to take intelligent risks, you must first build intelligent protection. That is what mature investors do. They earn the right to be aggressive by first being responsible. There is another reason cash matters, and it is psychological. When you have no reserve, you start watching every tiny market move like your life depends on it. You become reactive. You see red candles and feel your stomach drop. You see green candles and feel greedy. Your brain gets dragged around by noise. With a buffer, you return to thinking like an owner instead of a gambler. You stop needing every trade to pay your rent. You stop investing with a desperate mind. Desperation is a terrible financial advisor. Cash removes desperation. That is why it is priceless. If you want proof, look at every investor you respect. The patient ones always keep some liquidity. They do not brag about it because it is not sexy. But when the market offers discounts, they are the ones shopping while everyone else is posting excuses. They are not smarter because they predicted the future. They are stronger because they prepared for uncertainty. You do not need prophecy. You need prudence. You do not need luck. You need options. Cash is an option that never expires. Here is the hard truth you need to accept. If you invest every dollar you own, you are not brave. You are fragile. One unexpected event and your whole strategy collapses. Fragile investors break. Anti-fragile investors adapt. A cash buffer makes you anti-fragile. It lets you absorb shocks and convert them into advantages. The market rewards that kind of person again and again. It punishes the person who stays over-leveraged and unprepared. So build your buffer like your freedom depends on it, because it does. Start now, even if it is small. Put aside a portion of every paycheck or every profit until it becomes a real shield. Keep it separate, keep it boring, keep it ready. Then invest the rest with confidence and patience. This is not optional. This is one of the rules that keeps you alive long enough to win. You say you want wealth. Fine. Then stop operating on the edge. Stop giving your future to chance. Keep a cash buffer. Protect your downside. And earn the ability to play the long game. The successful investor is not the one who never faces trouble. The successful investor is the one who is always prepared when trouble arrives, and always ready when opportunity knocks. Investment rule number 6. Diversify intelligently. Diversify intelligently is not a polite suggestion. It is a survival law. If you concentrate your money in one asset, one sector, one country, or one idea, you are not investing. You are gambling with a blindfold. You are telling the market, please do not surprise me, even though surprises are the only thing markets guarantee. Intelligent diversification is how successful investors stay in the game long enough to win. It is not about chasing many things. It is about protecting your future from one bad turn of fate. Let us be brutally honest. Most people diversify the wrong way. They buy random stocks they do not understand, add a little crypto because it is trending, throw money into a fund because a friend mentioned it, and call that a portfolio. That is not diversification. That is confusion. If you do not know what you own and why you own it, then spreading your money across 10 mistakes does not make you safe. It makes you quietly fragile. Real diversification is organized, deliberate. and tied to your understanding of risk. Think of risk like fire. A single spark can burn a house down if everything is dry and connected. Diversification creates fire breaks. When one part of your portfolio is hurting, another part is steady, and another part may be rising. This balance is not magic. It is mathematics and human psychology working together. Markets move in cycles. Sectors rise and fall. Interest rates change. Political shifts happen. Consumer habits evolve. If your wealth is welded to one corner of life, you will feel every tremor as a disaster. If your wealth is spread wisely, shocks become manageable bumps, not life-changing collapses. Intelligent diversification starts with understanding correlations. You want assets that do not all react the same way at the same time. Owning 5 technology stocks is not diversification if they move together. Owning 3 real estate properties in the same neighborhood is not diversification if they depend on the same local economy. The goal is not quantity. The goal is difference. You diversify across asset classes such as equities, bonds, real estate, and cash equivalents. You diversify across sectors such as healthcare, consumer staples, energy, finance, and technology. You diversify across geography because one economy can slow while another grows. You even diversify across time by investing regularly instead of trying to pick the perfect moment. But here is the part amateur investors ignore. Diversification has a cost, and smart investors respect that cost. If you diversify too little, one mistake can destroy you. If you diversify too much, you become a collector of mediocre returns. Over-diversification is the silent killer of performance. When you own too many positions, you cannot follow the businesses, the fundamentals, the news, or the risks. You end up owning things you do not truly believe in. And when volatility hits, you panic because you never had conviction. Successful investors hold enough positions to reduce single-point failure, but few enough to stay informed and confident. That balance is personal, but the principle is universal. Another key to intelligent diversification is knowing your edge. If you understand a sector deeply, it can deserve a bigger slice of your portfolio. If you are weak in a sector, your exposure should be smaller or indirect. Diversification does not mean equal weighting of everything. It means weighting according to knowledge, risk, and role in your strategy. A high-growth investment may serve your future upside. A stable dividend investment may serve your cash flow. A bond allocation may serve your stability. A cash reserve may serve your flexibility. Every asset must have a job. If it has no job, remove it. Let us talk about emotional discipline, because diversification is not only about numbers. It is also a psychological weapon against stupidity. When your whole portfolio is tied to one idea, your emotions become hostage to every headline. You wake up anxious. You check prices constantly. You make impulsive moves because your identity is attached to the outcome. Diversification gives you breathing room. It reduces the pressure to be right all the time. It lets you think like a professional, not like a desperate gambler. You cannot control markets, but you can control how exposed you are to their moods. There is also a strategic layer to diversification that separates serious investors from casual ones. Scenario thinking. Smart investors ask, What happens if inflation rises? What happens if interest rates fall? What happens if a recession hits? What happens if one country enters a slowdown? They do not predict with certainty, but they prepare. They build a portfolio that can survive multiple realities. That is what seatbelt means. A seatbelt does not help you drive faster. It helps you survive the unexpected crash. In investing, survival comes first, because compounding only works if you are still alive in the game. Diversification also requires periodic maintenance. Markets move and your allocations drift. A position that was 10% of your portfolio can quietly grow into 30% just because it performed well. If you never rebalance, you end up concentrated again without noticing. Successful investors review their portfolios on a schedule. They rebalance to their target allocations, not because they are afraid of winning, but because they understand that risk expands when one winner dominates everything. Rebalancing forces you to take some profits from what became expensive and redeploy into what became cheaper. It is disciplined, not emotional. Finally, intelligent diversification is a long-term habit, not a one-day event. You do not need to own everything today. You build your portfolio in layers as your knowledge and income expand. Start with broad, understandable exposure. Add specialized positions only when you have earned the right through learning and experience. Keep your base stable. Let your growth portion be bold but controlled. That is how successful investors compound wealth without exposing themselves to a single fatal blow. So remember this rule in a direct, painful truth. Concentration can make you rich, but it can also make you broke overnight. Intelligent diversification may not feel exciting, but it is what keeps winners alive. It is the quiet engineer behind long-term wealth. If you want financial freedom, stop looking for one perfect bet. Build a portfolio that can survive mistakes, shocks, and time. That is how real investors win. Investment rule number 7. Think long-term. Think long-term is not a cute slogan. It is the dividing line between people who build wealth and people who only chase it. If you cannot hold an idea through boredom, noise, and temporary pain, you are not investing. You are gambling with a longer word attached. The market punishes impatience because impatience forces you to buy high, sell low, and repeat the cycle until your confidence disappears. Long-term thinking is how you step out of that trap. You need to understand the real nature of compounding. It is slow at first, almost insulting. You put money aside, you invest, you wait, and the numbers barely move. That is where most people quit. They look at a few months, sometimes a year, and they say, "It is not working." They forget that the first stage of compounding is invisible. The second stage is steady. The third stage is explosive. The people who get the explosion are the ones who survived the boredom. If you want the final result, you must respect the slow beginning. Short-term obsession is expensive in ways you do not notice at first. It makes you overtrade. It makes you stare at charts like they are a heartbeat monitor for your self-worth. It drags you into constant decision-making, and constant decision-making is where emotion sneaks in. Every time you react to a weekly swing, you pay a fee to someone else. You pay spreads, commissions, taxes, and the worst cost of all, the cost of being wrong at the worst possible moment. Long-term investors do not avoid mistakes completely, but they avoid the catastrophic mistakes that come from panic. Good businesses and good assets need time to prove themselves. A strong company builds new products, expands into new markets, recovers from bad years, and improves its cash flow. Real estate develops value through location changes, population growth, and rental demand over cycles. Even index funds are designed for decades, not days. If you judge a long-term asset by short-term movement, you are using the wrong ruler. You are like a farmer digging up seeds every week to see if they are growing. You destroy the very process you are trying to benefit from. Long-term thinking also gives you a psychological edge. The crowd runs on feelings. The crowd buys because prices are rising and sells because prices are falling. The crowd needs excitement to feel alive, and the market happily sells them excitement at a premium. You do not need that. When you think in years, you stop treating volatility like danger and start treating it like weather. Storms happen. Seasons change. The serious investor prepares for them, not by predicting every cloud, but by owning sturdy assets and giving them room to breathe. This rule forces you to focus on fundamentals, not noise. Noise is headlines, rumors, influencers, and daily drama. Fundamentals are earnings, cash flow, balance sheet strength, competitive advantage, and the long-term demand for what the business provides. Fundamentals change slowly, and that is exactly why they matter. If the fundamentals are improving, short-term price drops are opportunities, not threats. If the fundamentals are decaying, short-term price spikes are temptations, not signals. Long-term investors stay loyal to facts, not feelings. Thinking long-term does not mean being passive or blind. It means being patient with your thesis and ruthless with your standards. You buy with a reason. You hold while the reason remains true, and you sell when that reason breaks. That is discipline, not laziness. It is the calm kind of hard work that most people avoid because it does not feel heroic. But it is what wins. The market does not reward drama. It rewards consistency. You also have to match your time horizon to your goals. Money you might need next month does not belong in volatile investments. Money you are building for your future can handle short-term fluctuations because it has time to recover and grow. This is not optional. When your horizon is clear, your behavior becomes clear. You stop making emotional withdrawals from long-term assets to fix short-term problems. You stop sabotaging your future because you did not plan your present. Long-term thinking makes you resilient. You will face corrections, recessions, ugly news, and moments when your portfolio looks like it forgot your name. Those moments are normal. They are the entry fee for returns that outpace inflation and build real wealth. The investor who survives those moments with a steady hand ends up buying more at better prices, while the emotional investor sells to feel safe and locks in loss. Safety bought through panic is fake safety. Real safety is a plan built for decades. If you want proof that this works, look at any serious track record in investing. The winners are rarely the fastest movers. They are the ones who stayed invested, stayed focused, and let time do the heavy lifting. They understood that wealth is not created by one perfect trade. It is created by thousands of small, correct decisions repeated over years. You do not need to be a genius. You need to be consistent, patient, and willing to delay gratification when others are desperate for instant results. So here is the blunt truth. If you cannot think long-term, your money will always be working for someone else. You will buy after the rise, sell after the fall, and call it bad luck. It is not bad luck. It is bad time horizon. Decide right now that you are playing a multi-year game. Build a portfolio you can hold with confidence. Stop checking it like a lottery ticket. Start treating it like a farm. Plant, protect, let it grow, and harvest when the season is right. That is how compounding becomes your servant instead of your mystery. Investment rule number 8. Focus on quality assets. Focusing on quality assets is not a polite investing tip. It is survival. Most people lose money because they chase excitement instead of strength. They buy stories that sound good for a week, then collapse for a decade. You are not here to gamble. You are here to build wealth that can stand upright in every season. Quality assets are the backbone of that mission. They are not flashy, they are not loud, and they do not beg for attention. They perform, quietly, relentlessly, year after year. A quality asset is simple to recognize if you stop looking for miracles and start looking for evidence. A strong business earns real money from real customers. It does not depend on one viral product, one trend, or one charismatic leader. It has durable demand, meaning people will still need what it sells 5, 10, or 20 years from now. It has reliable cash flows, meaning it generates profit consistently, not just in lucky quarters. It has a balance sheet that can handle storms, not one that needs perfect conditions to survive. And it has a moat, some advantage that competitors cannot copy overnight, such as brand trust, network effects, patents, scale, or distribution power. This is what quality looks like. If you cannot explain why an asset is strong in plain words, you do not understand it well enough to own it. The reason quality matters is brutal and mathematical. Weak assets force you into constant decisions. You buy them, then you watch every headline like a hostage waiting for rescue. You panic on dips, you celebrate too early on spikes, and you sell at the wrong time because deep down you do not trust what you own. Quality simplifies your life. When you own something solid, you can hold through noise. Market fear becomes background sound instead of a command to act. You stop wasting energy reacting and start winning through patience. That is not psychology. That is strategy. Cash flow is the heartbeat of quality. An asset that produces steady cash is not a promise. It is a machine. It funds growth, pays dividends, buys back shares, reduces debt, and survives recessions without begging for capital. Businesses with clean, growing cash flows do not need to dilute owners or take desperate loans. They are self-sustaining. That is why they compound. When you invest, you are not buying a ticker. You are buying a stream of future cash. If that stream is weak, your future is weak. If that stream is strong, your future strengthens every year. Durable demand is another pillar that separates wealth builders from dream buyers. Trends come and go, but human needs are stubborn. People keep eating, healing, learning, moving, communicating, and protecting their time. Quality assets often sit in these areas, where demand is not a fashion statement, but a long-term habit. A company that solves an essential problem will still be relevant when the market has moved on from the latest hype. The investors who win are not the ones who shout the loudest today. They are the ones who chose what would still matter tomorrow. Quality also protects you from the most dangerous risk of all, permanent loss. Volatility is not the real enemy. A strong asset can drop in price and still recover because its engine keeps working. A fragile asset drops and never returns because the business itself was weak. The market is not obligated to bring your money back. If you buy low-quality assets, you are hoping for mercy. If you buy quality assets, you are trusting fundamentals. Hope is not a plan. Fundamentals are. Let us be honest about what low-quality investing looks like. It looks like chasing hot tips from social media. It looks like buying companies that do not make profits, but promise they will someday. It looks like confusing popularity for strength. It looks like mistaking a rising chart for a good business. Many people say they are investing, but they are really renting attention. They hold something only while the crowd claps. That is not investing. That is theater. And theater ends when the lights go off. Quality does not mean perfection, and it does not mean you never pay a fair price. It means you demand real strength before you commit your capital. You look for businesses that are built to last, not built to impress. You accept that great companies can be temporarily overpriced and still be great companies. You wait for reasonable opportunities, but you do not abandon quality for a discount in junk. A cheap, weak asset is still weak. A fair price for a strong asset is often a bargain compared to what it becomes over time. This rule also forces humility, which is rare but necessary. Quality investing requires you to admit what you do not know. If the business model is confusing, if the numbers do not make sense, if the competitive advantage is unclear, you step back. You do not pretend to be smarter than your confusion. You do not invest to prove confidence. You invest when the evidence is clear. That discipline is what separates mature investors from emotional buyers. Focus on quality, and you also protect your time. Tracking 10 excellent investments is easier than monitoring 50 questionable ones. A concentrated portfolio of quality assets lets you learn deeply, understand risks clearly, and act decisively when needed. Diversification matters, but quality is the foundation. Diversifying into mediocrity is not safety. It is slow-motion failure. If you want to apply this rule starting today, stop asking, "Will this price go up next month?" And start asking, "Is this asset strong enough to own for years?" Study the business like an owner. Look at its earnings, its cash flow, its debt, its customers, and its competitive edge. Ask yourself if it can survive bad years without breaking. If the answer is yes, you are looking at quality. If the answer is no, walk away, no matter how exciting the story sounds. Quality assets are not for people who want quick adrenaline. They are for people who want control, clarity, and compounding. They reward patience because they are built on reality. Your job is not to find the next shiny object. Your job is to build a portfolio that can endure, grow, and free you. Focus on quality assets and you stop being a victim of the market. You become a builder of wealth. Investment rule number 9. Track your decisions and learn from them. If you want to stop investing like a gambler and start investing like a professional, you must track your decisions and learn from them. Not someday, not when you have more money. Right now. Because the market does not reward hopes, vibes, or half memories. It rewards clear thinking repeated over time. And clear thinking is impossible when you keep no record of what you were thinking in the first place. Most investors lose money for one simple reason. They cannot tell the difference between skill and luck. They win once, they think they are geniuses. They double down, and then reality humbles them. Or they lose once, they think they are cursed. They quit, and they never discover that their mistake was fixable. A journal is how you cut through that fog. Let us be blunt. Your brain will lie to you. It will rewrite history to protect your ego. You will swear you knew it all along when something goes up, and you will invent excuses when something goes down. That is human. But you are not here to be human in the lazy sense. You are here to be dangerous with money. You are here to build wealth on purpose. So you need evidence. You need a written trail that shows what you believed, why you believed it, and what happened next. Without that trail, you do not have a strategy. You have a mood. An investment journal is not a cute notebook you abandon after 2 weeks. It is your private training ground. Every time you buy an asset, you write your thesis in plain language. What exactly are you buying? How does it produce returns? Why now? What are the numbers that justify the price? What assumptions must stay true for this to work? What could break the thesis? What will you do if that happens? You do not write for performance. You write for truth. If you cannot explain a decision clearly on paper, then you do not understand it clearly in your head. And if you do not understand it, you have no business risking your capital on it. Tracking decisions also forces you to confront your real behavior, not the behavior you imagine you have. Many investors say they are long-term, but their journal exposes that they panic at the first dip. Many investors say they are disciplined, but their journal shows that they chase headlines every month. Many investors claim they are diversified, but their journal reveals that they are loading the same type of risk in different costumes. The journal does not care about your self-image. It shows you who you are. That is uncomfortable. Good. Growth does not happen in comfort. You should also log your emotional state when you act. Were you calm, or were you angry after a bad day? Were you confident for rational reasons, or were you desperate because you felt behind? Did you buy because the numbers made sense, or because you were afraid of missing out? Emotion is not the enemy. Unnoticed emotion is the enemy. When you label it, you reduce its power. Later, when you review your journal, you will see patterns that were invisible in real time. You will notice that your worst buys happen after social media hype. You will notice that your best buys happen when you are patient, bored, and focused on fundamentals. That awareness is worth more than any hot tip. The quarterly review is where the real transformation happens. Every 3 months, you sit down and read your entries like a coach studying game tape. You do not judge yourself like a victim. You analyze yourself like a professional. You ask hard questions. Did the outcome match the thesis? If yes, was it because your reasoning was correct, or because the market got lucky in your favor? If no, which assumption failed? Did you miss a risk that was visible? Did you size the position correctly? Did you break your own rules? Did you hold too long out of pride, or sell too early out of fear? This is not an exercise in self-punishment. It is an exercise in precision. Here is the brutal truth. If you do not review your decisions, you will repeat your mistakes forever. The market will keep charging you tuition, and you will keep failing the course because you refuse to look at the exam. People who never journal learn slowly. People who journal learn fast. Why? Because feedback is structured. It is written. It is measurable. Improvement cannot be vague. It must be visible. A journal also protects you from the most expensive habit in investing, changing your story whenever the price moves. Professionals do not do that. They adapt based on facts, not on fear. If the thesis is still true, they hold. If the thesis breaks, they exit. Simple. But you cannot follow that rule if you never wrote the thesis in the first place. Then every dip feels like the end of the world, and every surge feels like proof you are right. That is how people get trapped. A journal anchors you to your original reasoning so you can compare it to reality instead of to your feelings. Over time, your journal becomes a mirror of your edge. You will see what types of investments you understand best. You will see what time horizons you handle well. You will see the conditions where you perform with discipline. You will also see your blind spots. Maybe you overestimate growth stories. Maybe you underestimate risk. Maybe you trade too much. Maybe you ignore valuations when you are excited. Whatever it is, the journal will reveal it. And once a weakness is revealed, it can be trained out. The investor you become next year depends on the lessons you are willing to face this year. Do not wait for perfection to start journaling. Start messy, then refine. The first goal is consistency, not beauty. Write after every decision. Review every quarter. Tell the truth on paper even when your ego screams. Because your ego does not pay your bills. Your process does. And the difference between a reckless investor and a successful one is not intelligence. It is the willingness to learn, to adjust, and to grow without lying to oneself. So if you are serious about wealth, stop leaving your progress to memory. Memory is weak, evidence is strong. Track your decisions, learn from them. Tighten your process, and watch how fast your results change when you finally stop guessing and start improving on purpose. Investment rule number 10. Make rational, data-based decisions. If you want to invest like a professional, you must stop treating money decisions like emotions with a price tag. The market does not reward hope, fear, pride, or excitement. It rewards clarity. Rule number 10 is simple and brutal. Make rational, data-based decisions. Not sometimes, not when you feel calm, always. Because the moment you let feelings drive your hand, you stop being an investor and become a gambler wearing a nice label. Look at how most people lose. They buy because a friend is hyped, because a headline screams opportunity, because a chart looks like a rocket, because they feel they are missing out. That is not analysis. That is social pressure. Then the price drops, and they panic sell. Or the price rises, and they get greedy, hold too long, and give back gains. None of that has anything to do with the real value of what they own. It is pure emotion. The market feeds on emotional money the way a fire feeds on oxygen. If you do not control your impulses, your capital becomes someone else's profit. Rational investing starts with a clear question. What is this asset worth, and why should it be worth more tomorrow than it is today? That forces you to study fundamentals. You look at earnings, cash flow, margins, debt, competitive advantage, customer demand, and the durability of the business model. You ask whether the company makes real money, how it makes it, and if that engine can survive a bad year, a new competitor, or a shift in consumer behavior. You do not buy stories, you buy evidence. If you cannot explain the business in plain language, you are not ready to risk your savings on it. Data-based decisions also mean respecting valuation. Price and value are not the same thing. Price is what the crowd pays today. Value is what the asset is truly worth based on its ability to generate future cash. When you ignore valuation, you become easy prey for bubbles. A great business can be a terrible investment if the price is too high. A boring business can be a brilliant investment if it is priced below its real worth. Successful investors check ratios, growth rates, and realistic scenarios. They compare current price to intrinsic value. They look for a margin of safety, a cushion that protects them if reality falls short of optimism. You also need to read trends like a scientist, not a poet. Trends are not predictions. They are patterns. They tell you what is changing in the world and where money is moving. But a rational investor does not chase every trend. They test it. They ask how long it could last, what risks could kill it, and whether the asset they are considering actually benefits from that trend or is just pretending to. The difference between a profitable trend and a dangerous fad is research. If you skip the research, you end up buying the top because you arrived at the party late and loud. A rational investor builds a thesis before buying. A thesis is your written reason for investing. It states what you believe, the data supporting it, and what would prove you wrong. It includes your entry price, your time horizon, and your exit plan. This is not paperwork for fun. This is discipline. When fear or greed hits later, your thesis is the anchor that keeps you from drifting into stupidity. Without a thesis, you will invent excuses in real time. You will call luck a strategy. You will call emotion intuition. And you will pay for it. Risk management is part of rational thinking. Data-based investing does not mean you are always right. It means you handle being wrong like an adult. You decide in advance how much you can lose on a position. You size your investment accordingly. You diversify with intention, not with chaos. You avoid leverage you do not fully understand. You keep a cash buffer. These moves are not pessimism. They are professionalism. You protect your downside so the upside can compound over time. One emotional mistake can wipe out years of disciplined progress. Survivability is a strategy. You must also understand your own psychology. You are not a robot, and pretending you are one is a lie that will cost you money. You will feel fear when prices fall. You will feel excitement when prices rise. The goal is not to remove feelings. The goal is to prevent feelings from making decisions. That is why you use rules, data, and checklists. You do the thinking before the storm, not during it. During the storm, you execute what you already decided. Emotional people react. Rational investors respond. So the next time you are about to invest, pause. Ask yourself, what does the data say? Not what do I feel? If the evidence is strong, act calmly. If the evidence is weak, walk away proudly. There will always be another opportunity, but there will never be another you. Respect your capital. Respect reality. Make decisions like a successful investor, and the results will follow.